Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be taking you through some interesting new research into trading behaviour so that you know what you need to do in order to be a better trader. I'll also give you my views on the All Ordinaries Index and this week's stocks of interest that you've asked me to look at. If you're a regular to this channel, welcome back, and if you're joining us for the first time, let me extend a big welcome to you. I'm sure you'll gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. And as always, if you have any topics that you want me to cover, or you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Also, before I get into the report, I just want you to click that like button just below. All good? Great. So let's get into this week's report. Would it surprise you to know that Monday mornings is when investors sell losses? Well, research has just been published in the Journal of Behavioural and Experimental Finance that says exactly that. The report was put together by RMIT researcher Dr. Daniel Richards, who is a lecturer in wealth management in the School of Accounting, and Dr. Giselle Willows, an associate professor at the University of Cape Town. Now, they investigated the days of the week and the time of the day that investors trade, and part of their research suggests that stock market investors are more likely to sell losses on Monday mornings. Now, to give you some background on the research report, the researchers looked at 7,200 UK retail investors, and they found a strong tendency was to sell losses on a Monday morning, but selling of gains occurred throughout the week. Further, they suggest that overall investors are reluctant to sell losses because of the anguish felt when a paper loss is crystallised into a real loss. However, this did not occur first thing on Monday mornings when the market opened. They also said that the research showed that market returns are higher on Fridays than they are on Mondays, indicating that investors are consciously or unconsciously influenced by mood, which affects when they trade. When asked why this might occur, Dr. Richards suggested two reasons. Firstly, selling a loss and Monday mornings both create bad moods, so investors choose to combine those two activities. Now, I don't necessarily agree with that. Secondly, selling a loss is a harder decision than selling a gain, so investors may use the weekend to digest their trading decisions. And I agree with that. The researchers also found that investors traded more frequently on Mondays than on any other day of the week. Now, Dr. Willow said if you look at Mondays, individual investors are buying and selling more actively compared to other days in the week. Now, this is different to institutional investors who trade less on Mondays. So what's my take on all this? Well, everything in the report is information already known by the industry. What we also know is that professionals close the market. They don't open the market. So naturally, having the mum and dad investors buying and selling on a Monday is not new news to us, because us professional traders, we buy more on Fridays. We also don't open the markets on the Mondays. We close them on the Mondays. So none of what I'm reading in this research report really is mind-blowingly new to me. Although what it is doing is quantifying what we're talking about and quantifying what we already do know. Because institutions are also the bulk of the market, meaning mum and dad investors don't make up most of the trading. In Australia, it's around about 75% of the market's trading is done by institutional traders, not individuals. And individuals trade on hope, using greed and fear rather than on solid strategies. In short, individuals react emotionally rather than logically, whereas professional managers act logically rather than emotionally. Now, the report goes on to talk about many things, and it's quite interesting to read. It's also great to see qualification of what we already knew or suspected was the case. Now, interestingly, it suggests that there was great variability between those who are susceptible to biases, meaning the masses who underperform, and those who are more experienced and sophisticated. In short, I believe the research is saying that those who are educated and experienced do not behave in the same manner as those who lack knowledge, and as a result, those with knowledge get better returns. That just stands to reason, doesn't it? More than that, I believe it shows that many believe they have knowledge, whereas in fact they do not, and are actually overconfident rather than knowledgeable. I was interviewed on this research this morning by a journalist in mainstream media, and this is how the research came to my attention, as it's just been released. Now, I've read lots of research reports on behavioural finance, and pretty much they all boil down to the same conclusions. In short, the masses are being influenced by events, news, and other external forces that cause them to make emotional rather than rational decisions. Basically, everyone is being normal. What most do not consider is that fund managers are also no different and exhibit behavioural biases too. So what can you do so that you get better returns and spend less time getting them? Plain and simple, that answer is to get educated. Here I mean real education, not some Mickey Mouse stuff that leads you to overconfidence, which the report proves does not work and causes the majority to not sell and make other poor decisions. Reluctance to selling at a loss, as the report mentioned, is one of the biggest sins a trader can make. This is simply caused by traders not wanting to quantify the loss, as doing so would be akin to admitting that they made a poor choice or did something wrong. The reality is quite different in that you need to understand that you cannot and never will control the market. You can only control your decisions to enter or exit. Not selling is a poor decision, and continued not selling only compounds the poor decision. Learning to exit is one of the most valuable skills you can develop for yourself to improve your profits. As the report suggests, selling a profit is much easier for the masses. But in my experience, traders do not follow one of the most important golden rules of trading, and that is let profits run, cut losses short. Selling early to secure a profit is one of the reasons why the majority get poor returns or fail at trading. Unlike popular thinking, you can go broke taking profits. Selling too early when in profit is a distinct sign of a lack of education, as the trader is selling because they do not know when the right time is to sell. One behavioural trait I find the majority of traders do is that they constantly blame the market or other external factors for their poor performance. They continually look for justification and validation of poor decisions. But having an excuse that does seem logical to you does not make you a better trader. It just continues to allow a poor trader to not take responsibility for their actions, and in doing so keeps them struggling to trade well. What these same traders do is fail to take in consideration the real cost of poor decisions and inaction. The cost can be time wasted, opportunity not taken, losses of capital, stress, anxiety, and the list just goes on. In the end of the day, if you wish to trade like a professional and make the money great traders make, then you need to know and do what they do. We know 90% of traders do not make money consistently, and so it should be abundantly clear to any logical person that the way to be a better trader is to not take much notice of the 90% of things that they see, hear, or read about trading. In the end, it's your money and your choice as to the journey you take as a trader, and you can make it as long and as hard or as short and as easy as you choose it to be. Being an outlier and not being a part of the herd will ensure your success. Now let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Alrighty guys, we had a lot of comments this week on the channel, so I won't be able to get through this whole 2 pages of it today. So what I don't cover, if you've actually asked me a question or brought up a stock and I don't cover it in this recording, please go and watch the live show tomorrow night, Tuesday, between 7 and 8 p.m. I will answer all of those and bring up the stocks that I don't do today in that live show, because some of those questions are great. and they're requiring a little bit more than a 30-second answer to them. So please just watch the show tomorrow night at 2 p.m. 2 p.m. Tomorrow at 7 p.m., 7 to 8 p.m. So just get on that. Looking at the screen right now, I've got the All Ordinaries Index. It is a weekly chart of the All Ordinaries Index as per normal. And you can see last week, instead of going down, it went up again. And we've seen this move. It opened at 6241. It did drop down earlier in the week. So if I go and have a quick look at a daily chart, you'll see Tuesday was a really big down week. And so that bar, you're looking at a 76-point range. It fell quite in a decent amount. And then it rose up towards the end of the week. Interestingly, on Friday, it closed way off its high. So it may indicate it may start to fall away this week. But again, looking at this, I did a bit of research for some articles. I do an article every week for the media on this, and looking at the market, it really hasn't had this many weeks up in terms of the amount of time it's been moving up and this sort of price. It's over 14%. It's risen since that low on the 20th of December, and it's risen over those 8 to 9 weeks. Now, it hasn't done that for over 2 years, and that's quite a rare occurrence. And if I go back, it'll be a few more years since then. And what I mean by a pullback, it really does need to come down. We need to see red bars, and really is this like a bit of like in a downward move. You can see over here on the left, it did rise up for a couple of weeks. So that's a movement in the opposite direction to the trend. We're needing to see that, and I still think it should go below about that 6,000 points to come down over 1 to 2 weeks. Right now, the probability of it falling is even higher than it was 2 weeks ago. So at this point in time, just sit back and watch. At this point in time. So now let's bring up some of the stocks, and you can see that the workbook, there is quite a lot of stocks to actually have a look at. As I said, I won't be looking at all of them. So while I bring all that up, I've got the first one from Ling Wen. He goes, "Hi Dale, thanks for an amazing video about ASX. Please keep up the good work. Can you please talk about PAC or PGH? I think it's PACT, not PAC. So let's have a quick look at PAC Group. I think their current price is undervalued and material sector is going well. Is it a good time to buy?" This stock just is going down. Have a look at it. It's just, I've never seen this sort of stock before. I've never seen this stock before, but I'm not sure why you think it's undervalued, but right now the market doesn't think that. The market's actually bearish. You can see that it made an all-time high up here in May 2017 at $7.34. It's now currently closing at $2.83. All I can see here is it's when you're looking at trading, it's very much is what it has been doing. You need to assume it will do it until it doesn't anymore. And to really give you some clarity around that is it's all I can see there is a stock that's falling away. That's what I can confirm. I haven't seen a stock. I can't see a stock rising in value. So if I see a stock that's falling in value, that's all I can confirm. And then that means I need to assume it's going to continue to fall away until it confirms it's not. And that's all about trading on confirmation, not speculation. So right now, I wouldn't be anywhere near this stock at this point in time. I've got one from SEMO. SEMO says, "Thanks, Dale. Appreciate your honest opinion and analysis of JMS." Oh, okay, so I did that last week, so I don't need to do that. No, sorry, I did that on my live session last week. So he said I brought up a few technical issues that I wasn't aware of, so it's definitely worth asking. Speculative stock, the reason why he brought that up is a lot of traders don't think about with their volatility. They just look at price, and price alone is not an indication that something's in a trend and that it's good. Got to look at volume and liquidity, and he was looking at liquidity in the right ways. And there's a lot of stuff. As a trader, what I find, well, it's not as a trader, but everybody, you don't know what you don't know. And I find when it comes to trading, the amount of things that people think they know but they actually don't know is amazing. It is 90% of traders I talk to tell me they know how to trade, and yet when I start asking them questions on a scale of 1 to 10, they're a 2, not a 10 like myself. So you're getting this misconception and people over confident about what they actually do know and what they don't know. Moving on, I've got one from Stephen Otts. He said, "Hi, I'm looking at AMI, Aurelia Metals, to buy on my watch list as a growth stock. Any thoughts?" I did ask him why on YouTube, and he says, "I'm looking at it as a short to medium term and have been interested in seeing its growth and seem to have been increasing volume and interest since late 2018. I'm new into stocks and only been studying for a few weeks. A lot of that's pretty wishy-washy in terms of my idea of what a stock should be doing. It's been really bullish, and you can see that on both the weekly and the monthly chart. So I need to assume it probably will continue to be bullish. Now, if I put volume on here somewhere, where's volume? There we go. Put some volume on the bottom. Volume is more since 2018 than what it was before. That's great, but it doesn't mean it's highly liquid. If we look at the last week, you can see there it's 14.5 million shares at 70 cents. That's not a hugely liquid share. Obviously, 70 cents into 14 million, it's not too bad, but it's not something that's super, super exciting. Right now, what is the reason to buy it? It's about, is it fundamentally good and is it technically good? Technically, it's rising in an uptrend. I don't have any issues with that. Technically, I believe it should still continue to go up. Should you buy it? Different question. It really does to look at your plan. When you're looking at short to medium term, people don't know where to get out. And so looking at short term on this sort of stuff is where are you going to get out? And a lot of people buy, but they don't know how to sell. And this is the important thing. If you're going to trade short term, you need to know your entry and your exit strategy. If you only have one, then you're going to be really, really hit and miss, because what if this thing starts to fall away? What if it rises for 3 weeks and then starts to fall away? Why if it rises for 8 weeks or 12 weeks and then starts to fall away? Where are you going to exit, and what's the trigger to be? That's buying on confirmation and selling on confirmation. So you need to know what the move is, the likely strength of that move, the direction of the move, how it's going to unfold. Just looking at some price alone, and volume is pretty much irrelevant, and I'll say that again. Most people overweight volume. Volume is next to useless to you as a trader unless you're trading highly leveraged day trading or intraday trading. It's pretty much useless to you. And the biggest thing that I could suggest traders do is throw volume right out the door in terms of triggering or telling you what's going up and what's going down and using it that way. Volume is only useful to me as a trader to look at liquidity and making sure I'm buying a liquid stock and something that's highly traded, which is about the earlier question on JMS by SEMO. So we can cover that again anyway on Tuesday night. Let's go to another one, Cochlear, we're going to bring up, and this one is by Robbie. Robbie says, "Hi Dale, love the channel, thanks mate, and really appreciate your dedication to helping Aussie families build wealth." Fantastic. Thank you very much for that. After reading your book and looking over charts, I recently bought shares in Cochlear after an uptrend buy signal of $173 and watched as they grew to $199. However, with the recent half-year report for Cochlear, I believe Cochlear is looking like it has started a downtrend. I set a stop loss of 15%. My question is, would you sell if the stock is starting a downtrend, therefore it hits your stop loss, or just wait it out? First thing is, I believe is not good enough to me. It's not a I believe. It's doing something. You need to know it's doing something, and what's the confirmation of all of that. It's had one down week. That's the down week there, down the range of $30 on a down week on Cochlear. It had a big hit given its report, but that does not ever constitute a downtrend. It doesn't even mean a downtrend's actually started. It's a down week. And what we're seeing over the last few years is more volatility on news, simply because anybody can just hit a button on a broker website and sell, and the fund managers know that, the big brokers know that, so they push stocks around. Looking at last week, we're seeing it opened higher than it closed the week before, and it closed higher. So it's, to me, there is always have your rules. Your rule is 15% stop loss. That's your rule for exiting. So based on your buy price. So that's where you stick to it. You don't change that. So that would be my rule on this case. And it's not just selling because you think it's starting to do something. And that's really, really important. Too many people really guess at what's going on. Now, for those who put some questions in for me in the past week, comments, stocks, etc. As I said a little bit earlier, I will be covering all of those on the live show, Wealth Within Live, tomorrow night, Tuesday, between 7 and 8 p.m. So do get onto that. I will cover them in a lot more detail. Like one from Ian, he's asking a bit about our courses and which ones he should do. He's a little bit confused about that. So I will be going through that a little bit more detail, because I find a lot of people understand they want education, they need more depth and structure to their trading. but they don't know how to get all that. So we'll be discussing all of that. And as I said, Janine, our senior analyst, will be on with me for the first time on the show on Tuesday night. So she'll be there. Janine's every bit as good as I am. She's equal to me in every single way in terms of trading, etc., and a wealth of knowledge. She's been with me for the better part. Well, I've known Janine over 20 years, and she's been trading. Massive amount of experience, and you'll get a lot of good content and a lot of good education from her. So make sure you put that in your diary tomorrow night, 7 to 8 p.m. Tuesday night, 7 to 8 p.m. So be there. I'll talk to you soon. Good luck. Good trading.